Hello traders, this is Yash from TFA. This session is recorded for the Bold project. The topic for this video is risk management. Okay, so let's start. So risk management is a very important topic. It's very important aspect of trading. Traders who cannot master risk management or who cannot be good risk managers, they cannot be good traders. However good accuracy you have, but if you're not good at risk management, you cannot be a successful trader. It's as simple as that. Okay. So often traders have two problems in their trading career. One of them is accuracy. Second is discipline. That is the risk management. Now, accuracy can be solved by better strategies or by better understanding of the strategies. Okay, that is like it can be solved. But the second problem, that is the discipline, that is the risk management, that cannot be solved by your mentor. It has to be solved by you. You have to solve it. Why? Mentor can only give you the rules. He can only give you a list of rules. But following those rules is your part. He cannot enforce those rules on you. He cannot make sure every time that you follow those rules. He can only give the list of rules. So where people fail, they fail in keeping the promises, they fail in following the rules. That is, they are indisciplined. So you have to make sure that the list of rules that we are going to provide you, to make sure you follow them. If you follow them, then we guarantee you that you're going to be a profitable trader in long run. When I say long run, I'm trying to say a week, a month, or even a year. Okay, fine. Okay, so let's start. So basically, there are three rules of risk management. The first rule is risk reward ratio. So this concept has already been covered in the previous lectures. Okay, so we know what is risk reward ratio. Risk reward is your risk, that is your maximum loss, divided by your profit, that is maximum profit. Okay, that gives you your risk reward ratio. Now, a good risk reward ratio, according to me, is anything greater than or equal to 1 is to 1.5. Any risk reward ratio at least 1 is to 1.5 or greater than that is good. Okay, so make sure you always follow a risk reward ratio of greater than or at least equal to 1 is to 1.5. So take only those trades which provide you a risk reward ratio of at least 1 is to 1.5. Those trades who are providing you less risk reward ratio, don't go for them. Okay, as simple as that. Fine, nothing to explain in the first rule since it has been already explained. So let's jump on to the second rule. Now the second rule is your 2% risk rule. So what this 2% risk rule says is that you should not risk more than 2% of your capital on a given single trade. So let's say for an example, your trading capital is 10,000 rupees. So 2% of 10,000 is 200. Okay. So that means on any given trade, your loss should not be more than 200 rupees. Okay. Let's say your capital is 20,000 rupees. So in that case, 2% of 20,000 is 400. Okay. So depending upon your capital, take the 2% of that capital and make sure that your loss is never more than the 2% of your capital. Okay. So this is a very simple rule, a very easy to understand rule, but trust me, one of the most difficult rules to follow. Why? Because of greed. People have more greed. Okay, they want to earn more profit. In order to earn more profit, they risk more. So when they risk more, they are not able to follow the second risk management rule. That is the 2% risk rule. Because obviously, in order to get more profit, you have to buy more shares. In order to buy more shares, you will be risking more as well. Okay, so in that case, you won't be able to follow the 2% risk rule. So, as I said, very easy to understand, but the most difficult rule to follow. And you'll understand this with experience. Okay. So, only thing I can, as I said in the beginning, as it said, that I can only give you the rules. Following them is your part. And this is where a lot of traders fail. They're not able to follow the rules. Why? Because they are indisciplined. They're not disciplined. Okay. So, you have to be disciplined in trading. You cannot be indisciplined and be a profitable trader. All the professional and profitable traders are disciplined. So you have to be disciplined as well. You have to follow the rules and you have to follow them always. You'll always see that whenever you're not following the rule or whenever you break a rule, then you're increasing the chances of a loss. As simple as that. Okay. So all I can say here is just keep your eyes closed and follow the rules blindly. Never break a rule. Okay. Fine. Let's jump on to the third rule. Now the third rule is simple as well. So the third rule is your position sizing. Okay. Now a very common doubt or a very common question that we mentors receive is, sir, how many shares should I buy or sell in a given trade? Okay. How do I decide that? That let's say I have spotted a trade in Reliance, but how many shares should I buy in that? How do I decide that? Okay. So that is the third rule. That is the third risk management rule. We should always follow position sizing formula. Okay. So the formula for position sizing is very simple. Position sizing is equal to your 2% risk rule divided by entry minus stop loss. Okay. So let's say that this is a resistance. Okay. Now a candle has closed above it. Okay. And there has been a breakout. So you're looking to go long at this point. Okay. And let's say this point is 180. Okay. So you're looking to go long at the price of 180 rupees. And you have decided to keep a stop loss below this support. Okay. Because this was a resistance earlier, it has been broken. So now according to the principle of polarity, it has become a support now. So you're trying to keep a stop loss at, or you have decided to keep a stop loss at 178. Okay. So now let's decide, or let's understand how many shares you should buy in this case. Okay. So let's apply the position sizing formula. Just give me a second. Fine. So 2% risk rule. Okay. So let's assume that your capital currently is 10,000 rupees. Okay. So 2% of 10,000 is 200, right? And entry minus stop loss, your entry is at 180, your stop loss is at 178. So entry minus stop loss, that is 180 minus 178, right? This is your position sizing formula. Okay, that is 2% risk rule divided by entry minus stop loss. So this comes out to be 200 divided by 2, that comes out to be 100. Okay, so that means you should, or you can buy 100 shares at the price of 180. Okay, and even if your trade fails, okay, so let's say your trade does not go in the direction as it was expected, and it fails and it comes down like this. Okay, and it triggers your stop loss. So even if it triggers your stop loss, the loss you will make is 100 into 2, right? So that comes out to be 200. Okay, so you're still within the 2% risk rule. Okay, so basically these, the second and the third rule, are interconnected to each other. So make sure that whenever you are deciding how many shares should I buy or sell, follow this simple rule. Okay, first take the entry price, then obviously you have to decide the stop loss before you take an entry. So take the entry price, take the stop loss, find the difference between it. Okay, and take the 2% risk rule. Let's say your capital is 10,000, so 200 divided by entry minus stop loss. Okay, so this is how you determine your position sizing, that how many shares should I buy or how many shares should I sell. Okay, so these three simple rules: risk reward ratio, 2% risk rule, and position sizing. If you just blindly follow these three rules, you'll be a successful trader. I can guarantee you that. Okay, I can guarantee and say that if you follow these three rules always, without breaking a rule even once, you'll be a profitable trader in long run. But are most people able to follow the rules? No, they are not. Okay, more or less. Why? Because of greed and fear. So because of these things, they are not able to follow these rules, because of greed and fear. If you can eliminate these two factors, greed and fear, you can be a profitable trader. If you can simply have discipline in your trading. How to have discipline? You have to follow the rules. Okay, and how to follow the rules, that I cannot teach, right? So you have to enforce that discipline in yourself, that whatever happens, I will follow the rules. Okay, fine. Now I just said that I can guarantee you that if you just follow these three rules, you'll be a profitable trader. Okay, so first let me prove it. Okay, so before proving it, let's just quickly revise the points. Okay, the three rules. The first rule is risk reward rule. So your every trade should offer you a risk reward ratio of at least 1 is to 1.5. That is the first rule. Second rule says that you should never risk more than 2% of your trading capital. Fine, that is the second rule. Third rule says that you should decide your position sizing according to the position sizing formula. Okay, fine. So these are the three rules. All right. Now let me prove to you that how you can never be in loss in long run if you always follow these three rules. Okay, fine. Okay. So first, let's say that you're a beginner, okay? And as a beginner, you have understood all the strategies, you have gone through the entire course, you have understood all the topics and everything. You're good to go now, okay? Now, whenever I ask this question to my clients that once you have finished the course, you're done with everything, okay? You have understood risk management, you have understood a lot of strategies. What is the accuracy that you're looking forward to that you'll have as soon as you start trading, okay? So the very common answer that I receive is 50%. Okay, and this is the like the least, okay, they are expecting. They're like some of them are like, sir, I can get an accuracy of 60 to 70%, okay, which is very good. All right, but the very least or the least answer that I get is 50%, because this is the minimum accuracy that they think that they can at least get. Okay, most of them think that they can get an accuracy of more than 50%. Okay, so it's like if you take 10 trades and your accuracy is 50%, you'll have 5 trades successful and 5 failure. Okay, so that is what is a 50% accuracy. All right, so most of them say 60, 70, some of them 75 as well. Some are very confident, some are less confident, they say sir 50. So the least or the minimum they say is 50. Okay, so and that is like, you will at least have 50 if you just follow the strategies properly. If you follow the every point of the strategy and you don't take risky trades, you be conservative and you follow every point of the strategy, you'll at least have 50% accuracy. Okay, fine. So let's take the number of 50%. So let's say you have started trading, okay, and you have an accuracy of 50%. Okay, so your accuracy is 50%. Fine. So that means, let's say that I just said that, if you just follow these rules blindly, you'll never be in loss in a long run. Okay, let's understand that how. Okay, so let's say long run means in a week, in a month, in a year, like that. Okay, so let's calculate for a week. So let's say in a week you take 20 trades. Okay, so in a week you have taken 20 trades. So according to the 50% accuracy, 10 will be successful and 10 will be failure. Right? Fine. Now let's say you follow all the three rules. The first rule is risk reward ratio of at least 1 is to 1.5. Okay, greater than that, equal to or greater than that, right? Fine. Second rule, 2% risk rule. Okay, so let's say in this example which we are taking, your capital is 10,000. Okay, so your risk is 200, maximum 200 in a given single trade. Third rule, you follow the position sizing. Okay, so you don't randomly buy or sell the shares, you always follow the position sizing formula. Okay, fine. Now let's understand. So you take 10 trades, okay, and you take 20 trades, 10 are successful, 10 are failure. Okay, and your capital is 10,000 rupees. Okay, fine. So now let's understand and let's calculate what will happen to you. Okay, what will happen after a week. So 10 trades have failed. Okay, and your maximum risk is 200. So let's say you make 200 loss in every trade because that is your maximum risk. Okay, obviously you'll be making less loss sometimes, you'll be making 150 or 100, but let's take the worst case scenario. Okay, so you make the maximum loss, that is 200. Okay, so 200 into 10 is 2000. So you have made a loss of 2000. Okay, now let's calculate your success. Okay, so as I said, you have to take a risk reward ratio of at least 1 is to 1.5. Okay, at least. So that means whenever you will be risking 200, okay, in that case your profit will at least be 300, right? That is what is 1 is to 1.5. Okay, if it was 1 is to 2, then 200 risk and 400 profit, right? That is 1 is to 2. Okay, fine. So let's again take the worst case scenario. Let's say you are only following a risk reward ratio of 1 is to 1.5, nothing more than that. Okay, so we are calculating everything in the case of worst case scenarios. Fine. So let's say you make a profit of 300 in every single trade. So 300 into 10 successful trade makes plus 3000. Okay. So at the end of the week, after taking 20 trades, you have made a profit of plus 1000. And this was in the case of worst case. So, okay, so we had taken a worst case scenario. We took the worst possible accuracy. Okay, we took the maximum loss. All right, and we took the least profit. And still we saw that still after a week we ended up in profit. Okay, so this is the reason why I've said that I can guarantee you that if you just follow these three rules properly, you'll always be in profit in long run. Okay, all you have to do is just blindly keep your eyes closed and follow these rules, as simple as that. But why do traders still fail? They are not able to follow these three simple rules. Okay, fine. So this is your risk management, as easy as it can get. Okay, but as difficult as it can get to follow it. Okay, so again the same thing I'll say: easy to understand but difficult to follow or difficult to implement. Okay, fine. So this was your risk management. Okay, now the next two things that we're going to understand is your trading journal. That what is your trading journal and the importance of it, and trading plan. That is what is a trading plan and the importance of it. Okay, fine. So let's start with the trading journal. Okay, so what is a trading journal? Trading journal is a simple journal, okay, which you maintain, recording all your trades. Okay, so you record every trade that you have taken in the market in your journal. Okay, and how is it useful? How is it important? This journal helps you to monitor your accuracy. It also helps you to go through your trades later. Okay, so let's say you're free in the weekend, so you have decided to go through your trades which you have taken during the weekdays or in the previous week. Okay, so if you maintain a journal, you can always go through your trades by just going through your journal. Okay, and you can see which were the mistakes you made and which were the profits you made. Okay, and you can clearly understand that where you need to improve. Okay, so journal helps you to understand what are the areas that you need to improve on. Okay, and it also helps you to monitor your accuracy, as simple as that. Okay, fine. Now I'll be showing an example of a trading journal. Okay, so this is an Excel sheet which have been created by us. Okay, so this is an example of a trading journal. I would recommend you guys to create similar one. Okay, so it's very simple. You can just open an Excel and create a similar one. So what I have in this, or I'm just showing you an example, you can create a similar one. So I'll just show you what I've done. So I started with starting account balance. Okay, so here you're supposed to put your starting account balance. Okay, so let's say you're starting with 10,000 or 1,000. Okay, so you're supposed to put it here. Okay, and one thing about this journal is that all the white columns are the columns which we have to fill. Okay, and the gray columns are the columns which will be filled automatically. Okay, fine. So I'll show you an example of a trade. So let's say today is 17th November. I'll just enable editing. Fine. So today is, just a second. So today is 17th of November. So let's say I've taken a trade today at 9:18 a.m. I went long. Okay, so you're supposed to write that. Stock, let's say M&M. Okay, my entry price was, let's say, 680. My account balance at that point of time was 1,000. Number of shares that I bought was, let's say, 50. Okay, my stop loss price. Okay, so let's follow the risk management in this as well. So since my capital is 1,000 and I cannot risk more than 20 rupees in this scenario, so my number of shares should be maybe 10, and stop loss price can be just 2, that is 678. Okay, so in this case my risk management will be followed. Okay, so my risk is 20 rupees, that is 2% of 1,000. Okay, fine. Take profit price, let's say it is 684. Okay, so first of all, this is planned risk reward ratio. Okay, R is to R, planned risk reward ratio. So this automatically calculates your risk reward ratio after you have logged in your stop loss price, target price, and entry price. Okay, so it tells me my risk reward ratio is 1:2. That is good. Okay, and it also tells you the percentage of account risked. Okay, so that is 2%. That is also the rule which I followed, the 2% risk rule. Okay, so you have to make sure that you follow this and this. Okay, like this should be at least greater than or equal to 1 is to 1.5, and this should always be less than or equal to 2%. Okay, so this trading journal will help you in monitoring that. Okay, fine. After that, you have to write the actual exit price. Okay, so let's say my target price was 684, but I took an exit at 683.5. Okay, fine. Now this trade cost is nothing but your brokerage. Okay, so you get a combined contract equity note in the evening at in your email ID sent by your broker. Okay, so that tells you how much brokerage has been charged by the broker. Okay, so let's say the brokerage charge in this case was 10 rupees, or let's say 6 rupees. Okay, so you write that here. Okay, after that you'll see what was your profit. Okay, and what was the change in your account. Okay, so that means what was the change percentage in my account. So my account changed by positive 2.9%. Okay, fine. So these columns are not like this column is not that important. So if you want to include a screenshot of your trade, you can do that. So take a screenshot of your trade, write the entry, and just draw the entry and stop loss and everything, and include the screenshot in this. Okay. In trade notes, you're supposed to write the strategy that you have followed. Okay. So let's say I have followed buy at support. Okay. So I followed the strategy buy at support. Okay. Fine. Now next thing is discipline rating. Okay. Now this is very important. This discipline rating is very important. All right. So in this, what you can do is that for this we'll need to understand the trading plan first. Okay. So let's combine that. So the second thing which you're going to understand is the trading plan. Okay. So trading plan is a plan that you create for yourself, for your trading journey or for your trading career, for day-to-day trading career. Okay. So in this plan, you'll be basically writing down the rules that you'll make sure that you follow every day. Okay. And what is your plan? What are you looking forward to? Okay. What is your target? What is your, how much you are targeting in a week, in a month or so. Okay. So basically a plan, a trading plan. Okay. And you should always have a plan. If you don't have a plan in your trading or in your life, then you don't know where you're heading to. Okay. So you should have a plan in trading as well. So create a trading plan. Okay. So I'll be showing you a example of a trading plan of one of my clients. Okay. So this is a trading plan of one of my clients. So he has listed down 10 rules. Okay, and he makes sure that he follows all the 10 rules when he's trading or whenever he's taking a particular trade. Okay, so these 10 rules, and he has written 1 point of for each. Okay, so whenever he follows all the rules, he grades himself out of 10 and gives himself 10 out of 10. Okay, if he manages to follow all the rules. Okay, if he does not follow a rule, let's say he did not follow the risk reward ratio rule, that is his risk reward ratio was not more than 1 is to 1.5. Okay, so he deducts 1 point. So in that case his score would be 9. Okay, and whatever your score is, you write that down in your discipline rating. Okay, and make sure that this discipline rating should always be 10. Okay, see, don't relate your happiness with profit or loss. Okay, so don't relate your happiness or sadness with profit or loss respectively, but relate your happiness with the discipline that you're following. If you're disciplined enough in a trade, and that means you'll get 10 out of 10, right? So if you're getting 10 out of 10, you should be happy. It doesn't matter you made profit or loss in that particular trade. If you start relating your happiness with the discipline, you'll end up being a professional and a profitable trader. Okay, fine. So always relate your happiness with the discipline, not with the profit or loss. Okay, fine. So whenever you follow all the 10 rules, you grade yourself 10 out of 10. Whenever you don't follow a single rule, you deduct one point out of that. Okay, fine. And the last column is emotional state of mind. So what was your state of mind while you were taking the trade? Were you excited? Were you nervous? Were you anxious? Okay, or were you stable? So whatever it is, you can just write it down. So let's say I was stable. So you write down stable. And discipline rating, let's say I was properly disciplined. So I give myself 10. Okay. So again, I don't look at profit. You're supposed to look at the discipline. If your discipline rating is 10, you should be happy because you are going in the right path. It doesn't matter you're making profit or loss. Okay. If you're able to get 10 in every single trade, that means you are going in the right path. In the long run, you will be definitely making profit. Okay, always remember that. In short term, let's say for a day, you might make a loss, you might end up in a loss. Okay, but if you are following the discipline perfectly and correctly, then definitely in long run you'll be making profits. Okay, always remember this point. Easy to understand, difficult to follow. Okay, fine. Okay, so this is your trading journal. Okay, so maintain this. This will tell you your like what is the percentage of account risk and everything. Then second sheet is the trade summary. So this is the trade summary that we have created. Okay, so this one tells you the exact summary of your trades. So total number of trades, your what is your accuracy till now. Okay, total number of winning trades, total number of losing trades, what is your average winning trade, average losing trade, largest winning trade, largest losing trade, total brokerage that you have paid till now, what is your total profit and loss till now, what is your average profit and loss per trade, what is your return on investment till now, okay, what is your average risk per trade, and what is your average reward per trade, and what is your average risk reward ratio. Okay, and this also helps you to monitor your accuracy month by month. Okay, so currently my, like in the example, my accuracy is 100% in November. Okay, then in the December also you can see what is your accuracy. So you can just monitor your accuracy month by month just to see whether is there any change, or did you try something new in a particular month and has it worked out or not. Okay, this shall help you in that, and this will also help you like what was the risk reward ratio that you followed in a particular month. Okay, and make sure this should always be greater than 1 is to 1.5. Okay, and you can always monitor that, whether your risk reward ratio is falling month by month. If it is falling, then you know that something is going wrong and you need to change. Okay, fine. So try maintaining a journal like this and it'll help you a lot. Make sure that you always log in your trades. Okay, because see, what people generally do, what traders generally do is that they take a trade in the morning, they get up off their seat and they never come back. Okay, that means they never come back in the same day. They don't sit in the evening and evaluate their trades. Okay, which is wrong. You should always sit in the evening and evaluate your trades. Okay, see, trading is a profession which can give you a lot of profits. It can become a first source of income as well, but you have to work hard for it. Okay, again, this is a very common example that I give to a lot of students, a lot of clients, that you work hard for 15-16 years to get a starting salary of 30-40,000. Okay, and you're not even ready to work hard for at least a year or two to get good in trading and make it as a source of income. Okay, so nothing comes without hard work. You have to work hard. Okay, if you think that trading is a profession where it doesn't require much hard work, it is easy, or it is an easy money. Okay, then you're wrong. Okay, you'll have to work hard even for this. If you're ready to work hard, then trading will benefit you. Okay, if you're not ready to work hard, trading will not benefit you. Okay, so yes, this maintaining this trading journal will take a little bit of hard work. You'll have to sit every evening and log in your trades like this. Okay, if you do it, you will be in profit. Okay, it will be beneficial for you. If you don't do it, then I think you like, try to do it. Don't have this thing only that not to do it. Okay, so try to always follow this trading journal thing and all the rules. Okay, and it should be, eventually all the things should get good. Okay, fine. So this was the concept of trading journal. Okay, fine. Now let's understand trading plan. Okay, so I'll go through every point of trading plan and we'll understand that what is the point. Okay, fine. The first point says that use cover order and don't let a winner become a loser. Okay, now first let's understand why he has written, my client, that use cover order. Okay, so most of you would have gone through the video of types of orders. All right, so there you might have understood what is a cover order. So you might have seen in that in regular order, first you have to place a entry order, then separately you have to place a stop loss order, and then separately you have to place a target order. So you have to place three orders separately in regular order. Whereas in cover order, it is a combination of a entry order and a stop loss order. So you can place entry and stop loss together in a single window, in a single order window. Okay. So now the reason why he has enforced this rule in his trading plan is, see, what people do generally is, in regular order, first you have to place your entry order. Okay. Now what people do is that they don't place a stop loss order because they, because of laziness and all of these things. Okay. So because of this laziness and like these things, they think, okay, they'll have a stop loss in their mind. So they think that whenever the stock comes back to this price, or it comes back to my stop loss price, I will exit the trade. Okay, but when it actually comes to that price, their mind does not allow them to exit. Okay, so it's always good to place a cover order, because in this case you'll have to mandatorily be place a stop loss. You have to, it is mandatory to place a stop loss, otherwise your order cannot be fulfilled. Okay, So that is the reason why he has this rule of use cover order, so that it is mandatory for him to keep a stop loss. Okay, and keeping a stop loss is very important. Never, ever, ever trade without a stop loss. You might think that this trade is going to be 100% successful. Okay, but trust me, at any point of time, any strategy can fail. Any given strategy can fail. Nothing is 100%. No, none of the strategies are 100%. Accuracy is 60, 70, 80 max. Nothing more than that. Okay, so you can never be 100% sure. Okay, there could be a confluence of strategies, there could be a confluence of everything might be telling you to go long, but still the trade can fail. Okay, so never be 100% sure, you can never be 100% sure, so always place a stop loss. Okay, because at any given point of time anything can go wrong. Okay, fine, let's move forward. So the next point he has written is, don't let a winner become a loser. Okay, now let's understand this point, which is quite interesting. So what he has said is, don't let a winner become a loser. Okay, so that means whenever a trade is going successful, okay, or it is successful, then don't let that successful trade become a losing trade. Okay, so let's say for an example, so till now you guys might know that we placed two targets. Okay, so target one like this and target two like this. Okay, so let's say this was a resistance. Okay, there was a breakout, you went long at this position or at this point. Okay, so in that case what people generally do is they place two targets. So this is my target one and this is my target two. Okay, so basically what this point says is that don't let a winner become a loser. Okay, so that means if your target one has been achieved, okay, and let's say your stop loss is here, so once your target one is achieved, don't let it go and hit your stop loss. Okay, or don't let this winning trade become a loser trade, as simple as that. Okay, so how can you, how can you do this, how can you not allow a winner to become a loser? It's simple. Once your target one is achieved, bring your either you exit at target one. That is one option, you exit at target one as soon as your target one is achieved. Okay, the second option is that you don't exit at target one, but you bring your stop loss to the entry. Okay, or just a little above the entry. Okay, so let's say your entry is at 180, so you bring your stop loss to 180.1. Okay, something like that. All right, and then you shift your target to this one. So this is your target now. Okay, so these are the two methods that you can follow. So whenever your target one is achieved, make sure that in that trade you don't make a loss then. Okay, that is what is the point, that don't let a winner become a loser. Okay, fine. Second rule says that follow every point of the strategy. So whatever the strategy that you're following, make sure you follow the every point of it. Don't take a risky trade or like that, anything. Okay, third rule is use risk management. So he has written 3%. Okay, so he is following a 3% risk rule. Okay, and position sizing rule. Okay, fourth is don't increase the stop loss. Okay, this is very important. So what people generally do is that, let's take for an example. So the same thing, there was a breakout of resistance and you went long here. Okay, and you place the stop loss at this point. Okay, now what happens is that price starts coming down. Okay, so it starts going opposite, all right, what you had predicted. So what you do, you bring your stop loss from this point to this point. Okay, never do this. All right, don't change your stop loss. Okay, only take your stop loss above. Okay, in this case, so let's say your stop loss was 178, you can take it above it, you can take at 179 or 180, that is fine, but don't take below. Don't increase your loss. Okay, that's what I'm trying to say, because if you increase your loss, then obviously you are not following the 2% risk rule. Okay, because as I told you, position sizing rule and the 2% risk rule, if you increase the stop loss after some time, that means your loss will be more than the 2% risk. Okay, fine. Fifth rule says that don't average out and don't trade in excitement and be relaxed. Okay, so this is obvious, don't trade in excitement, be relaxed, never have excitement within yourself. Okay, trading is a very disciplined profession, you have to be very disciplined, you cannot trade in excitement, don't be excited. Okay, always be fearful. All right, always be like that. Okay, don't be excited, never be excited, because you'll often make mistakes in excitement. Okay, so be as patient, be as calm as you can be while trading. That will benefit you a lot. All right, now don't average out. So what this point says is that, let's say you bought at 180. Okay, your stop loss is at 176. Okay, this is your stop loss. Now price comes down to 178. Okay, so what you do, You have taken an entry here already. You buy more shares at this point. Okay. So this is known as averaging out. Okay. This is sometimes good, sometimes not good. Okay. But to be able to differentiate that when it is good and when it is not, you'll require some experience. Okay. So as a beginner, I would suggest don't average out. Okay. Fine. Next rule is risk reward ratio more than 1 is to 1.5. That is the same first rule of risk management. Seventh rule is don't revenge trade. So what is revenge trade? See, basically revenge trade is that when you have made a loss in a particular trade, okay, and then you take a trade again in that particular stock to just recover your loss. That is known as a revenge trade. Okay. So never do a revenge trade. Okay. Because see, always the market is superior. If it is giving you a loss, accept it and move on. Never go against it and never fight with the market. If you fight with the market, then you will always lose. Remember this point, as simple as that. Okay. So if you have taken a loss from a stock, accept it and move on. Okay. This is also one of the reasons why a lot of traders fail, because they don't have that capacity to accept the loss. Okay. They have ego, they have attitude, and because of that ego problem, they are never able to accept the loss. Okay. So you have to go down in front of the market. You have to accept that the market is superior and you are inferior. Okay, fine. Don't overtrade. No more than 3 trades in a day, and don't catch a falling knife. Okay, this is interesting. So don't overtrade. That means, so he has made a rule for himself that he'll not take more than 3 trades in a day. Okay. So again, like don't take a lot of trades in a day. Don't take 5, 6, 7 trades. Okay, it becomes a lot. All right. Like have a limit for yourself. 3 trades in a day are more than enough. Okay, more than enough. Okay. Sometimes people like just take 1 trade in a day and they are fine. Okay. Sometimes not taking a trade is also a profitable trade. Okay, because you don't know, it might have gone against you. Okay, fine. Don't catch a falling knife. What does this mean is that, see, what a lot of people do is that they try to catch the falling knife. So this is a support. Now price is coming at this point. Okay, so the price is falling and it is coming at this point. So they randomly buy at support. Okay, because they think the price will reverse from here. Okay, see, don't do this thing. Okay, wait for a confirmation. We have learned the strategy buy at support, right? So in the case of buy at support, what you do is that you wait for a bullish candlestick pattern. Okay, so wait for some bullish signal here, then go long. Okay, so don't randomly buy at support. That is what is, don't catch a falling knife. Falling knife is like falling price. So don't catch a falling price randomly. Let it show you some bullish signal. Okay, once it shows you a bullish signal, then you can go long respectively. Okay, fine. Next rule says that don't trade if already achieved 10% in a day, 25% in a week, or 50% in a month. Okay, so this is like he's setting a target for himself. So if he has achieved 10% in a day, he won't trade further. Okay, if he has achieved 25% in a week, so let's say he has made 25% on Wednesday. Okay, by Wednesday, so he won't trade on Thursday and Friday. Okay, and 50% in a month. So let's say he has made 50% of his capital. He has made a 50% return by 22nd of a month. So he won't trade for the rest of the days or for the rest of the month. Okay. Then he'll start his trading on the first day of the next month. Okay. Fine. This is also a very important rule. You should know when to stop. Okay. Fine. And 10th rule is don't break a rule. Good. That is simple. So always try to follow these rules. Okay. 10th rule is the most important rule, that is don't break a rule. Okay, follow these 10 rules and you'll never make a loss in long run. Never ever you'll make a loss in long run. Okay, and just follow these risk management rules, follow trading journal, follow trading plan, follow risk reward ratio, follow the position sizing, and follow the 2% risk rule. And trust me, you'll never make loss in a long run. You'll always be profitable. Okay, but if you have made a loss in a long run, then the reason for that is indiscipline. Okay, so just go through the rules once again and you'll understand why you have made a loss. Okay, fine. So I think things are clear till here. All right, thank you.